Hi folks, and welcome back to Meaningful Money. Here I am in a field, not far from my house actually, just one of my get out there and get a video done quickly type locations. My daughter's birthday party today, so all a bit rushed. It's the tax year end. We've talked in episode 193 actually about ISAs, capital gains tax allowance, other things that you need to be thinking about at the tax year end. It's the turn of pensions today. So as ever, before we get into it, my good friends down here in the bottom right, Seven Investment Management, who continue to sponsor me here on Meaningful Money. I'm very grateful to them for doing so. So pensions. Pensions are an incredibly tax efficient way of saving, as I've often said on this program. So it's a good time of year to be thinking about how you can maximize that. If you're self-employed, or even employed actually, doesn't really matter, remember making pension contribution effectively extends the basic rate tax band. So if you're going to go into the high rate tax band, then making a pension contribution would mean that instead of paying more tax, effectively more of the tax goes into your pension, so you're paying yourself rather than a tax man. So something to think about. Talk to your accountant if you've got one, talk to your financial planner if you've got one, about how to use pension planning to decrease your tax burden. Very important. But there are two particular things that I wanted to mention about pension tax year end planning. So I'm going to scooch over here, bring in a graphic and go over those. Now the first is called carry forward. There is an annual allowance, a maximum amount you can pay into a pension in any 1 year. But you are allowed to carry forward any unused allowance from the previous 3 tax years. So here we are at the very end of the 2011-2012 tax year. That means that if you didn't use your annual allowance, which is £50,000 by the way, if you didn't use it for the 10-11 tax year, the 9-10 tax year and the 8-9 tax year, if you didn't contribute up to £50,000 in your pension in those years, you can now carry those allowances forward and make one big payment now. The reason why this is important at the end of the tax year, of course, is that as we move into the next tax year, then the oldest of those tax years, which would be the 8-9 tax year, will drop off, and so any unused allowance then in that year is lost. Now the £50,000 limit was only put in place last year. So if we're talking before that, so 3 years ago, then it's a notional £50,000 limit. Now what does that mean? Well, it's fairly straightforward. It means that, let's go back to the earliest of our 3 preceding years, which would be the 08-09 tax year. Well, if, let's say, you only made a pension contribution of £20,000 in that year, that means you have a £30,000 unused allowance that you can now carry forward to this year. But it's important that you know it's a notional allowance, because let's say that in the 09-10 tax year you had a really good year and you put £70,000 into your pension that year. Well, that obviously is in excess of the 50,000, but it doesn't matter because it's a notional limit, and back when you made that contribution the annual limit was way more than 70,000. That matters because let's come forward one more year, so we're now in the 10-11 tax year, and it wasn't such a good year, and so you only paid £30,000 into your pension in that year. Now, just because you made an overpayment notionally in the previous year doesn't mean that that overpayment swallows up the allowance in the next year, in the 10-11 tax year. Long and short is that each year is discrete, so it's a £50,000 limit, but if you made over that, it doesn't matter. It only matters if you made under, because if you made under, you can carry it forward. Hope that's clear. It's easier to do than it is to explain, as is often the way with pensions, I find. A couple of other caveats. You have to have been a member of the pension scheme into which you're contributing in the year that you are carrying forward from. So if you weren't, say, at your current employer or whatever, in the 08-09 tax year, you couldn't use that scheme to carry forward. But other than that, remember it's a notional allowance, and remember that it's important because once we go into a new tax year, then that earliest tax year drops off the equation, and any allowance in that year that you haven't used is wasted. So that's carry forward. Another important one, particularly for this tax year, because it's a sort of one-off thing, is something called fixed protection. With pensions, there is a lifetime allowance, which is the most that you can have in your pension funds throughout your life. Okay? Currently, it's £1.8 million, but as of April 6th, it's going to become £1.5 million. So if you are currently in the position where you have more than £1.5 million worth of pension benefits, but less than the 1.8, you're going to have a problem on April the 6th, because suddenly, even though you're under the new allowance, when the new allowance drops, you're going to be in excess, and so you're going to have a problem. But fortunately, there's something you can do, and it's called fixed protection. And it is simple as filling in a form. You need form APSS 227, catchily titled. You'd think they'd just call it a fixed protection form, wouldn't you? But that's the revenue for you. You just search for APSS 227 on the Inland Revenue website and download that form. It's dead simple. It's essentially your name, address and your national insurance number. Not much else than that, I think. And send that to Revenue before the 5th of April, and you will get that fixed protection. It just locks any benefits that you've got in excess of £1.5 million. Now, I know what you're thinking. Is there anybody watching this with benefits in excess of £1.5 million? Well, very possibly. I had a client only in the last couple of weeks where this was an issue, because he had been a very senior member of the company that he's now retired from, and his benefits put him over that limit. We nearly missed it, and I'm ever so glad that we didn't, because because he's in a final salary scheme, there isn't a fund as such. He just has benefits. If you're in a final salary scheme and you're not receiving your pension yet, then whatever that pension is going to be, remember it's a defined benefit scheme, so they can tell you exactly what your pension is going to be. You multiply that by 20 to see if you are over the 1.5 million or not, and this gentleman was, and so he's done the form and he's going to be okay. So, two really important things to remember. Just shove the graphic out of the way. For pension planning at the end of this tax year. One is using your carry forward so that you don't lose that 08-09 tax year allowance if you haven't used it already. And the other one is fixed protection, a one-off thing you must do before the 5th of April if you have pension benefits in excess of 1.5 million. Okay, that's it for tax year end planning, I think, particularly pertaining to pensions. That's called an alliterative ending. Next, we're going to do peer-to-peer lending. So thanks for watching this one, and I'll see you next time.